let's give a recap on term insurance. The basics. Term equals temporary. They both start with the T. It gets too expensive over time to keep for long periods of time, so it's said to be temporary coverage. It is always going to be the least expensive, at least initially, because you're not putting extra premium dollars in that goes into the cash value. There's never a cash value on term insurance. Therefore, you can never have a loan on a term policy because it's a loan against cash value. You have no cash value, therefore you can't take any loans. There's nothing to loan it from, right? So no loans on term insurance, and it is said to mature at death, meaning it will pay out to your beneficiary if you die. There are basically 3 types or structure to term policies. One is the level term. One is increasing, that's the one that's used as a rider typically, and then there's decreasing term that is used to cover a debt. As your debt gets paid off and the value of that loan goes down, your death benefit matches exactly what you owe. Every time you make a payment, the amount that you owe is less, the death benefit drops and always mirrors what you still owe on your loan. The features that are offered sometimes on term, there's not a whole lot. Again, this is pretty simplified coverage. So on term, you can have a renewable feature, which means you get to the end of the term or the period of time you've had the first amount of coverage. If it's renewable, you would be able or allowed to go ahead and renew for another period of time. If it's that annual renewable term, again, it's going to cost you more every year. As you get to be a year older, your premium is going to go up accordingly. And then there's a convertible feature, which is not a bad thing because a lot of people start out purchasing term insurance because it is initially the cheapest. So it's a way to get people into insurance. And then if you have a product that you sell them, a term product that has a convertibility feature on it, it means they would in the future at some point be able to convert the term insurance to some other type of cash accruing policy later on. So it's a great way to kind of do some planning, and help them say, okay, let's get you your coverage today. Let's use term because it's cheaper right now. And then as your income is better or as your expenses drop, then maybe we can get you into a policy that's going to maybe have a little bit higher premium, but it'll have some cash value accrual, which is always a great feature for many people to think about. So the convertible feature could come in very handy for certain customers. So the general uses for insurance, it gets you the maximum coverage for the least amount of premium cost initially. Increasing term is used as the riders. Decreasing term is used to pay down your debts. As you pay down the debt, your death benefit matches what the new balance is that you owe on the debt. As it decreases, the life insurance decreases as well, till you pay off the loan and the policy is now done as well.